Welcome to the Investing Ahead podcast. I'm Tom Curran. My guest today is Kevin Curran. He is also co-CEO and my sidekick in that respect. And last time I talked to Kevin, the big topic was long-term investing. And in particular, I wanted to talk about long-term investing against our philosophy and that of Warren Buffett and Charlie Munger. So Kevin, Charlie Munger is someone who has a kind of a unique way of looking at investing. And I think while we are very much like that, I think that it's become more apparent to me, the sustainability of growth and earnings and revenues over the long term. So at any rate, talk about, not Munger, I don't want to talk about Munger, but let's talk about long-term investing and how important quality, revenues, earnings are to a company's ability to prosper and survive.
Sure. It's timely because we recently lost Charlie Munger. He sadly passed away at the beginning of the month. Approximately 1 month shy of his 100th birthday. What many fail to realize about the investment philosophy, which is what you want to focus on, it was really his investment philosophy that influenced Warren Buffett. Many don't realize that. Warren Buffett took the limelight while Charlie Munger was happy to play the Ed McMahon role to his Johnny Carson. The focus is investing on your best ideas, be willing to concentrate in them, and not get too hung up on conventional measures like valuation, price to earnings ratios, and so forth. It famously became known as it's better to buy a great company at a fair price than a fair company at a wonderful price. And that is what we've tried to do at our firm. And we've defined it as quality. And quality to us means organic revenue growth, consistent earnings per share, low debt to equity. And all those measures are important. If you start with revenue growth, it's going to be hard to grow the company on a sustainable basis without organic revenue growth. You can get away with it for a period of time, sometimes even several years, up to several years. But at some point, you need to be able to have a sustainable revenue generating business to grow the company. We start with that. Then that has to translate to earnings per share to generate the return for the investor. At some point, the capital expenditures, the administrative expenses, R&D, research and development expenses need to flow through to the bottom line and show profitability. Oftentimes in the early stages of a company's development, they can grow revenue at the expense of earnings because of the reinvestment in the company. But at some point, the shareholders will demand the company show profitability. It's important that the companies, for us, exhibit low leverage, and that is the risk management measure. companies with low levels of debt have less risk in that you don't have to worry about
interest rates going up.
Interest rates going up for starters. Yes, yes, very important. It's good to invest in a company that's not dependent on what its creditors view the company on any given day. That allows the company ample leeway to pursue its interests without having to worry about its creditors, debt holders. Then we focus in on creating a portfolio that's limited to the best companies. We don't want to own all the companies out there or a highly diversified portfolio, because that gets at what Charlie Munger used to like to describe as diversification. Why do you want to own the average or the company that once a decade is going to hit on a given year? If you focus in on the best companies over long periods of time, that's going to be the way to be. And we came out of a year not long ago, 2022 would be an excellent example. Last year, what did well? Defense companies profiting off the war in Ukraine, and energy companies, fossil fuel companies. It had been over a decade since Exxon, to pick on Exxon or Chevron, any of the big integrated oil and energy companies, had produced anything of a premium market return. Conventional investing would say, well, you've got to hold them for those periods when they do outperform. Our view is if you can ride through a period of a year where they might outperform, then why would you want to have that detract from investing in the best companies? And sure enough, this year, energy companies are back to plodding along, trailing the market.
I think investors, I find, probably pay more attention to earnings per share than anything else. It seems like every time I hear someone talk about the prospects for a company, it's earnings per share, which I understand. But one of the easiest ways to manipulate an income statement is earnings per share. So, as we know, if I buy back half my shares, borrow the money, buy back half my shares, my earnings could more than double. They could double even if my net profits were flat. And I sometimes, we can create value. If a company has too much cash and they don't know what to do with it, it may very well be a useful investment for them to buy back some stock. That's adding value. But what happens, particularly during a low interest rate period, companies bought back stock at ridiculously low interest rates. They borrowed the money, and that was great while it lasted, but it's not sustainable. And there is one company, we'll talk, we probably shouldn't talk about companies, but there's one very large tech company that's probably considered the father of tech that had no debt at all 25 years ago, and today has a severely highly leveraged balance sheet and is struggling to show earnings improvement because they can't buy stock back with borrowed money anymore. They've got to have real money to buy stock back. So we tend to look at net earnings a lot because net earnings are the earnings. If there was one share, the net earnings would be easy to track. But because there are multiple numbers of shares and buying them back, we don't look at net earnings. We look at earnings per share. So I think one thing that people who are listening to this might ask themselves is, how much emphasis does Wall Street how much emphasis do I place on earnings per share? And do I ever ask the question about whether they're real earnings or engineered earnings? I think adding value by buying back shares is a useful thing for a company to do. While it's useful, it can be done at an extreme and be highly deceptive in terms of what the investor might think and not necessarily be real. So we look at earnings per share, but we also look at net earnings. And that's one of the little subtle things that I think is important. And that, of course, a company that can, as Kevin described, organically grow revenues and earnings, why that's more important than a company that might acquire earnings. Are they buying the earnings, or are they getting their earnings from internally generated technology advances, improvements, efficiencies? So we kind of look at not all earnings are the same. And the way I like to do that, Kevin, and I know I've told you this many times, if you were looking for a rich wife, or I were looking for a rich wife, or our daughter was looking for a rich husband, and we lined up 10 people on the opposite side and said, these people all make exactly the same money. We're only going to look at this from an economic point of view. Are they all worth the same? The answer is no. Their net worth will be different. One company might be out there borrowing money, spending money, getting the earnings, but they've got nothing to fall back on. Another company might be generating everything from cash, saving money at a 15 or 20% rate. And so in addition to the earnings per share, they have a huge net worth on their balance sheet. So which would you rather have? Someone who had big earnings, living from paycheck to paycheck, or another that had big earnings but had a lot of money in the bank? And of course, we all know the answer to that. So we're looking for companies with money in the bank, not just current earnings.
Right.
And we define a quality company as having that characteristic. So we look beyond earnings per share. We actually look at balance sheets before we look at the income statement. So Kevin, talk a little bit about why we think retained earnings to common equity is important. Now, let me define that first. Retained earnings are those earnings that are kept in the company and not paid out in dividends.
Right. Companies that have a high percentage of retained earnings tend to have growing businesses. We found that to be the case time and again, defining factor of the companies we invest in, because they have good ideas. They're reinvesting in the company at higher rates than the market. Companies that tend to have exhausted their growth would then issue dividends. So counterintuitively, some investors may think dividends can be a good thing. They tend to be a sign that a company is no longer growing, is maybe turned into a cash cow. We like companies that have many years of growth ahead of them and reinvest in the company. And that's measured by net income to shareholder equity. And if that rate is high, that is a company that we would like to look at much more closely for investment. And your points about earnings per share are well taken, because it is a number that's easy to manipulate over the short run. We like to look at companies that have proven track records of many years of earnings per share growth. To drill down further, people have many names for it. You refer to net profits, operating income, is a number that is can't be manipulated, and that tends to show a company that is truly growing its profitability for shareholders. You can see examples of companies that can continue to grow earnings per share for several years and at the same time have flat operating income. It's usually a red flag. We've come through a period where companies can manipulate earnings per share by issuing bonds at low interest rates, using the proceeds to buy back stock. It's something that gets the attention in the headlines, and I take a neutral view of stock buybacks. If company's stock is cheap, it can make sense to buy it back. The hows and the whys of a company buying back stock, probably best for not suitable for this podcast.
Right.
But
Kevin, that's a good point. I don't want to, I probably, it may have sounded like I was saying stock buybacks are a bad thing. That wasn't my purpose. My purpose was they can be. It's not the rule, but they can be a very, a practice that may be a signal that there are problems.
Correct. Yes.
I'm glad you did that, Kevin. Let's talk a little bit about companies in respect of the dividend. We talked about dividend rates. A lot of investors are very interested in the dividend rate. And when you were talking, we usually, companies that pay high dividends are companies that have less growth, generally more debt, and pay out the cash because internally their growth doesn't warrant them keeping it. And we call that enhancing shareholder value. Now, there are companies out there who earn 15, 20, 25%, 10% on their cash. That is, they invest it in a way that gets a very high rate of return. Now, those are the companies that we tend to be attracted to because they are growing. And one of the things I like to, in explaining that, because it can be a little clouded in terms of an investor understanding it, would you rather own a company that wasn't really growing, didn't have a really, wasn't doing much with the cash, and they gave you a 5% on your investment return? Or would you rather have a company that was earning 20% on the cash and decided they'd keep it themselves and earn 20% on it? Which is, well, we call that value and growth. Value being the higher dividend yield, growth being the approach that doesn't pay dividends or doesn't pay dividends in the amounts that other companies pay. But all investors have to make up their minds which of those philosophies they agree with. They shouldn't, I don't think, let the need for cash generate the investment. And I think that's where mistakes can sometimes happen. Well, that pays 7% or this pays 6% and 7 is higher than 6. I sometimes say the higher the yield, it's like your temperature. If you're getting a higher yield and you don't know why, you're the greater fool. If you know why and you understand why and the risk it entails, then that's fine. That's why the U.S. Treasury bill is considered the riskless rate of return. That doesn't mean that a AAA note yielding a little bit more is all that much risk, but there's an additional risk, and incrementally that risk grows with the yield. And that as investors, we need to know what that is. And if we don't know what it is, we don't want to invest in it.
dividend yield can be high for a reason.
A reason.
Invariably.
Right, right.
And it's usually not good. But investors fall for that big number time and time again without asking the question why.
Right.
It gets down to capturing and knowing the risk involved in investing in a company. Interestingly enough, this year, the companies that have performed the poorest are high dividend yielding stocks, dividend paying stocks in general, because with interest rates going higher, there's an alternative now. People are buying bonds again. They're buying T-bills, particularly because they're paying out a rate. Whereas 2 years ago, they paid out nothing. It's increased the competition. People maybe don't realize the why, but would you rather own a T-bill paying 5% that's riskless, or a company that's struggling to stay in business that has an unsustainable dividend yield of 5%?
You've heard me ask a question. Someone may say to me, oh, I'm getting, well, in today's market, if the T-bills are paying 5%, let's say a short-term investment elsewhere is paying 8.5%. And someone will say, well, I'm getting 8.5%. And I say, well, there's a risk involved in that. Do you know what that risk is? And they usually don't know. I mean, I don't know what that risk is unless I really analyze it. But the question I usually raise is, why would they pay 8.5% if they could only pay 5%? There's got to be a reason. No one pays more because they want to be nice to me. I have to know why I'm getting more. They're not being nice to me. And if they could get 5%, they'd do it at 5%. So what's the catch? What do I need to understand? And, I think that might be too simplistic, but on the other hand, I think every time if we go to buy something and it seems to be too cheap, it's, too good to be true, that we say that to ourselves. But when it comes to investing, I don't think we ask that very intuitive question, why?
That's why they should come to us.
Right, exactly.
For help. Everything boils down to what is the risk, right, and what is the reward?
What is the reward
for this investment? Right. And too often people resort to, well, it's high yielding or it's going up.
Right. And again, I want to point out, it doesn't mean that we don't buy high yield or we don't buy higher yielding securities and implicitly then take a higher risk. But we know what it is that risk is, and we know what to be looking for so that we're not holding a bag, an empty bag.
An empty one.
Well, we didn't see that coming. You don't ever want to put yourself in that position. But the longer I've been in this business, it happens to all of us. There are always surprises, but they shouldn't be totally shocking surprises.
Right.
Kevin, since you've been working with individual investors, Kevin initially worked on the institutional side with pension funds and larger investors. And these last 4 or 5 years, he's focused more on individual investors and their needs. Kevin, what do you think is the biggest difference, the biggest challenge in meeting the needs of an individual investor?
I think often individual investors do not have a understanding of what it is they own and how they are doing it at any given point in time. So it's very important to try to speak to investors where they are and make it informative, educational, without it seeming like their eyes are glazing over, going back to 5th grade science. That I would say is the biggest challenge, and it's become increasingly obvious to me that if you are confident in your skills and investment philosophy, that you do need to illustrate and point out clearly to the client how well they are doing. I used to take it for granted that when I was doing a good job, they would simply know it. I didn't have to tell them. But the level of trust that their client is putting in you, it might sound self-serving, but there is a element of chest thumping that needs to be done. So they have a clear understanding of how well they are doing. And the flip side of that is when you are not doing well, you need to take responsibility for it and explain it in an understandable way for the client why it's not time to bail and double down. This is the test. This is why most investors fail, because they are bailing out, they're selling out at the worst possible time when things are bad.
Kevin, you know that one of the parts of the business that I've tried to be very, very upfront about is I think every investor should absolutely know to the decimal place how they're doing. And it's been one of my big issues, trying to, with a click of the key, get that return. And I thought that was intuitively important, that people would really want that. And we spent a lot of money, continue to spend a lot of money on software that gives all our clients the ability to get their net earnings after expenses on all their accounts with a click.
Yes.
And I am absolutely amazed that I would say almost no one thinks it's important. And I committed a great deal of time, energy, and money to making that available to all our clients. And I'm still amazed that, I can go and click on that key, and on the screen in front of me, I can see my net return for the day, for the quarter, for the year, back to inception 20, 30 years ago.
Well, the industry hasn't bought in because the dirty secret is many don't really want their investors to know how they are doing. Right. They'd rather have it be a little bit of a opaque, murky mystery. Right. They'll tell them when they're doing well, and they'll just kind of let it go. And when they aren't doing well, your question though about individual investors, to make this topical for the current times, things that are filtering through. People are asking about the Magnificent Seven, right? What are the Magnificent Seven? Well, I anything you can write down, I do, rather than try to commit to memory. So it's Apple, Amazon, Alphabet, Meta, Microsoft, NVIDIA, and Tesla.
You've got them.
Got all seven.
Okay.
Now, of those seven, we have considerable exposure to several, and
have for many years.
Many years. And so, investors, the individual investors that you're referring to, they kind of fall into two camps, right? Those who see them going up and they want to buy more, and those who are leery and want to sell, right? Neither answer, this doesn't surprise you, neither answer is really correct. Because what happened is we bought the companies we own. Apple is a great example. When at a point in time in the financial crisis, when everything was on sale, and it was a bargain. And we knew that we were buying a great company at a great price, and we needed to own it for many years. So at that time, when we bought it, we were, not to get lost in the weeds, but relative to the S&P 500, we owned a lot. All our clients owned a lot of Apple, a lot more than they would own if they simply went out and bought an index fund or an ETF. Well, what's happened after all this time? Apple is now 7.5% of the S&P 500. We actually own less in Apple than you do by owning the market. It's not a bad thing, because the challenge and why you hire us to invest for you is we've moved on. We're happy continuing owning Apple. It's a great company. And we actually have less risk in Apple than you do if you buy the market. Our challenge is identifying the next Apple.
Right.
And what would that company be? We have candidates that we own. We have candidates that we are watching. And some of the companies, the next Apple of tomorrow could already be in our portfolio. Is it Novo Nordisk that is making the weight loss drugs that are getting a lot of headlines? I think it very well could be. It could be more recent. We've only owned NVIDIA, which is our best performer for a year. I think there's a long runway in NVIDIA ahead. And we own, in relative terms to the market, we are considerable exposure to both NVIDIA and Novo Nordisk. So the idea isn't to back the truck up and buy more Apple or Microsoft. The idea and the notion in having a portfolio where you're generating above market returns is what is the next company.
Right. And I think, Kevin, a lot of times we're asked, how long do we hold these companies? It wasn't too many I think a couple years ago, Novo Nordisk seemed to be on the downside. They didn't have a lot in the pipeline, new drugs coming out. And our approach, the way we analyzed it, was no, it wasn't a time to run. We had serious discussions about selling some of it. We determined that the fundamentals were there. This was a company that kept reinventing themselves, coming up with new products, and they did. And that's what the great companies do. They almost create their own obsolescence, but it's not at the expense of another company. It's at their own expense. That is, they create their own obsolescence and they grow beyond that. They're the truly great companies that don't wait for the other company to put them out of business. They are, in fact, doing it on a day-to-day basis with new products they are building and developing. But Kevin, it's been great having you with us. I thank you for watching this podcast. This is Tom Curran. Goodbye with thanks.
Thank you for watching and listening to the Investing Ahead podcast with Tom Curran. Look for the Investing Ahead book and audiobook available everywhere. Executive producer Brendan Kennedy. Directed and produced by John Wager. Engineered and edited by Adam Russell and Aided Fitzsimmons. Filmed and recorded at Galileo Media Art Studios. Copyright 2024 Thomas Curran. All rights reserved. For more information, visit investingaheadpodcast.com.